After introducing myself and Miss Patty Ayala, we have Miss Leslie Rincon from Gateway Mortgage. Hi, Leslie. How are you doing?
Hi, girls. I'm good. How are you?
Doing good. So Leslie, tell us about you.
I'm Leslie Rincon with Gateway Mortgage, and I am the branch sales manager here and for the Laredo office. Gateway is a nationwide company, so we've got branches in all of the United States. And I have loan officers aside from myself, and we originate mortgage loans, FHA, VA, and conventional here in Laredo. So.
Oh, great. Do you have some years of long years of experience, right?
Yes, I've been doing it since I was 5, about 15 years. 15 years, that's it.
Bueno, pues actually we do have some questions for you. I know that everybody's actually here, interested on learning what to do when they want to purchase a home. There is a lot of terms and things that they don't know about, but that they should know. So when I purchased my home, they told me the word mortgage. I actually didn't know what that was. Can you elaborate a little bit more on what is a mortgage?
Right. So mortgage is basically your home payment. Your mortgage is your principal, interest, taxes, and insurance, everything that you pay on a home. You've got car payments, you've got student loans, you've got all types of different credit. Mortgage is basically a loan on a house. That's what it is.
Okay. And Leslie, I have a question. Now, what does it actually include in a house payment? What does it include?
So like I mentioned, it's going to be principal and interest, which is the loan that you're actually getting to finance the home. And it's going to include taxes and insurance. Now, there are people that ask sometimes, well, can I pay the taxes on the side? Can I pay them at the end of the year? Can I pay them with my income tax return? And yes, that is an option, but it's only an option for certain programs. Most of the time, that option is only given if you're going to do 20% down payment and if you're going to do a conventional loan. On an FHA loan, the government is now very strict and does require that your taxes and insurance be included in your mortgage payment. And that's to avoid the risk that one day you don't have the money to pay the taxes and they don't take your house away. So we try to always suggest to the borrower that they include their taxes and insurance in their payment to avoid that happening in the future. You never know, even though we might plan for it, we might expect that tax return is going to come and we can pay our taxes, something might happen and that money's not there. The last thing we want is for somebody to lose their home because they didn't make their tax bill.
And it's a fixed rate, right, Leslie?
Yes, now there are fixed rates and then there are variables or ARM loans. Personally, I recommend a fixed rate because then your mortgage will never change, but that's only for your principal and interest part. We have no control over taxes and insurance. So just the way you hear, taxes are going up, they're going up in Webb County, the school taxes are going up, things like that. That affects, of course, your mortgage payment because it's included in your payment. But what principal and interest is a fixed rate. So if your principal and interest part of your mortgage is $500, it's always going to be $500 for the life of the loan. What will make your payment change is going to be any changes in the taxes and in the insurance.
Awesome.
Oh, that's great. So you did mention it was principal, interest, taxes, and home insurance.
Correct.
Now, talking about insurance, I know that there's a lot of different types of loans. And you right now mentioned FHA, conventional, and, some people don't know what's the difference in all of them. Could you elaborate a little bit more on that?
Yes. So basically, as simple as possible, FHA is a government loan. Conventional is a private bank loan. And then you got VA, which is a loan that is available for veterans. So they each have their own different requirements. They each have their own different criteria. And lender per lender will have different requirements as well for the type of loan that they can give you. On an FHA loan, you are required to have mortgage insurance on the property or on the loan, for the length of time that you have your loan open. So mortgage insurance is actually an insurance that only covers your lender. It covers the bank, whoever you're getting the mortgage from. That's what that insurance is for. On an FHA loan, what everybody is aware of is that it's an insurance that you have to have for the life of the loan. A lot of people opt to do a conventional loan because they say, then I don't have to pay mortgage insurance. And that's correct, but it's only up until you owe less than 80% of what your home is worth. So at the beginning of the loan, if you finance 97% of your loan, which is the max that you can finance on a conventional, you're still going to have to pay mortgage insurance for some time. Now, realistically, it takes you about 7 years to get to that 80% loan to value. So you'll actually come down 20% from what your house is worth, somewhere between 5 to 7 years, depending on the market, of course. If the homes are appraising higher and your house increases in value really fast, if maybe you got it as a really, really good sales price, but it was actually worth more, you can get to that limit much quicker, and you can opt to get rid of that mortgage insurance at the time on a conventional loan only, not on an FHA loan.
Oh, that's great.
Oh, okay. Good to know. Now, a lot of people have a lot of questions concerning their credit scores required, what they need to qualify. Can you tell us a little bit more about that?
Yes, so credit scores are a real touchy subject because a lot of people tend to get their credit score from Credit Karma. And I personally do tell people, do you have a Credit Karma account? Open a Credit Karma account. Credit Karma is a very good app. They should pay me for this, right? Because I'm advertising.
It's a tool that we can use.
Everybody get a Credit Karma. No, Credit Karma is a very good app for you to know what's going on in your credit. Is somebody running your credit? Is somebody, using your credit? Is a payment posting on time? Maybe I sent my payment to Bell's, to JCPenney. I sent it in the mail and it hasn't posted. You'll find out right away when you're late on a payment. You'll find out right away if your credit got checked. You'll find out a lot of things that happen to your credit immediately when you have a Credit Karma account. However, the scores that Credit Karma give you, if you look at it, it tells you in the very fine print that it is a Vantage credit score. It is not a FICO credit score. So if you go in to look up the information for Vantage, it explains to you that the way they calculate the credit score is different. They weigh each account differently. So your car payment might weigh more than a regular student loan, than a regular finance company loan, than a credit card. So all of that criteria tends to change the scores that you could get on a Vantage credit score and a FICO credit score. So even though they're not going to match, people call me and tell me, well, Credit Karma says that I have a 650 credit score. Sometimes the FICO score will be lower than that. Sometimes it will be higher than that. It's very hard to determine that because we don't know what kind of accounts are on your credit report. So even though the credit app is good, it's good for you to know personally what's going on with your credit account or your social security number, really. Aside from that, credit scores, we go off a FICO credit score. We check 3 credit bureaus. It's TransUnion, Experian, and Equifax. And we take the median score, meaning if you've got a 630, a 620, and a 650, the median score is a 630. That's the one that's going to count. We're also going to look at the lower of the 2 applicants. So if you've got a husband and wife applying for credit and the husband score is a 640 and the wife scores a 700, unfortunately, we still have to look at the lower of the 2 credit scores, okay? That's when we determine as a lender, what is best for you? Do both people in the household work? Are they both going to contribute income for this house payment? Do we actually need both credit reports? Do we actually need both credit scores? And again, going back to each program is different. And the FHA loan will require us to have a credit report for both borrowers, for both applicants. Even if they're not on the loan, we have to know what's on that credit report for the other spouse. So on an FHA loan, we are going to have to pull both credit reports, regardless of whether the second person is on the loan or not. On a conventional loan, the other person who's not going to apply on the loan is not going to matter. We're not going to look at the credit report. We're not going to look at the credit score. Now, personally, again, we go back to the borrower and we have to know what's your budget, because I might not look at the spouse's credit report and she might have a car payment. She might have, student loans. If I don't take into consideration that that's also a expense for the home, I might be putting a borrower into a very bad situation, giving them a loan based on what he makes, even though she makes no money and has debt. She's got debt that his income should be covering. So we always have to go back to the borrower and say, what is your budget? Based on the income that comes into your home, what can you afford to buy? If you're currently renting and you're paying $800 to $1,000 in rent, do you honestly have that extra income to go into a mortgage that's higher than $800 to $1,000? Or do we have to find you a loan that's going to be between 800 and 1,000, which is what you're already used to paying? So as a lender, we need to look at that so that we're giving the borrower the correct loan.
And that's good, because I really, really like that you have to take that into consideration, because they usually go in through their gross, right? Not their net.
Correct.
No, that's great, because that's what we also look at. We look at everything in between, especially when we do the counseling session, right, Claudia?
Yes, we include that. We actually do something called the budget action plan. It's not that we were trying to control you, but we want to help you out better. It's not that we don't want to see you all here after coming into our counseling sessions, but it's we don't want to see you here with Patty, right? Patty not
Sorry.
only,
We don't want you to go to a default.
Yeah, one of the we have various programs here in NeighborWorks Laredo. Not only do we dedicate ourselves as for teaching you and guiding you how to purchase a home, but we also guide you as for in case you're falling into default on your mortgage loan, in case you're not able to pay, there was a job loss or something, which in case right now with everything that is going on, if that is the case, you're not able to make payments, please contact us. Please contact Miss Patricia Ayala, and she is the expert on that kind of information in foreclosure prevention. Okay,
yeah,
so
not that I don't want to see you, but we just don't want you to go through that situation. That's why I'm glad that Leslie does that and takes everything into consideration, just like we're going to be telling you. That's why it's very important to take the counseling session after you take the eHome class online.
Yes.
So if any questions, please let us know, especially if you have any home buying questions or foreclosure, credit, let us know.
Yes, again, sorry that I am repeating myself with this, but please, if you're going through a moment that you are currently loss of income or something, and you're an owner of your own home, or know of somebody that is going through that situation, please do give us a call to 956-712-9100, and we will inform you a little bit more on regards into that matter. Now, yes. I know, Leslie, when I went with my lender, and I know I use my examples a lot. I am known as Claudia Tragedias because I didn't know what I was doing.
Todo le pasa.
Yeah,
no le pasa a alguien más.
Yeah, they don't teach you this at school, they told me about ratios, and I was like, I thought of ratios of, something that they teach you in math. I know it's kind of math, but can you elaborate? What are the ratios?
So ratios, it's a debt to income ratio. I recently had somebody text me and tell me, I have a 700 credit score. Can I buy a house? And great, 700 credit score is great. A lot of times, however, if you have a 700 credit score, you probably have car payments, have student loans, have, credit cards, of course, because you have great credit. Unfortunately, having great credit means having a lot of debt sometimes. And so when we look at your credit report, we have to look at it for all your debt. How much debt do you have on your credit? On a monthly basis, what do you have to pay? You have a mortgage payment? Do you have a car payment? Do you have credit cards? And we look at that monthly payment required. We compare it to the income. So you've got debt of $500 a month, and you've got income of $2,000 a month. Okay, so then we're going to take a ratio and we're going to see what ratio your debt to income is. In that ratio, we're going to be able to determine what do you have left to pay on a house. So maybe you already have 50% of your income tied up in all this other debt that really doesn't leave you room to have a house payment on top of that. Because like Patty mentioned, we look at your gross amount. You don't actually take that home. You pay taxes off that money. You have other deductions that might be coming out of that gross income. So we have to leave room. So that other 50% that, rule of thumb, 50% debt, that's it. And every program is going to be different. And every guideline, every program has its own guidelines. So we have to at least take a look at generic 50%. So if you're grossing $5,000 a month, the true amount of debt limit is supposed to be 50%. That's $2,500. If you already have $2,500 of debts, car payments, like I mentioned, credit cards, student loans in your debt, in your credit report, then what is left for you to pay on a house? As for all these programs that we're about to go into here in a little bit, the down payment assistance programs, they have debt to income requirement. They have limits on that debt to income. They don't want you to hit 50% debt. because they don't want you to be, forced to, the only thing I have left is enough to buy groceries. What about your utilities? What about your phone payments? What about your car insurance? All these things don't come out on your credit report. So there are things that we don't have a way to consider them. I mean, unless I'm going to be the intrusive one and look at your bank statements and tell you, well, you tend to kind of go out to eat a lot, and you go to the movies, and you pay these other things. I don't do that. The credit counselors, yes, let's do that.
We do that.
All these home buying
We
counselors,
definitely do that.
go to Claudia, go to Patty, let them know what you spend your money on. But
Oh yeah, we're gonna see everything.
they're gonna see everything on those bank statements, and they're gonna tell you, hey, stop eating out if you want to buy a house. And that makes sense. Somebody sometimes has to take a look at our budget and say, you know what, you really do make enough money to pay all these bills you have. You just spend it in the wrong places. And a lot of times people are not applying to buy homes because they think they can't afford it. They think they don't qualify. And some of the reason that we think we don't afford things is because we don't have any money left between one paycheck and another. And then our W-2s come in at the end of the year. It's like, wow, I made all that money. Where did it go? We have no house to show for it. We have no car to show for it because we spent it in the wrong place. So the home buying counseling is very, very important. I definitely promote the classes. I want people to go and be educated, and what can I do to limit what I'm spending so that I can afford to buy a house? Because that way I'm putting them in a loan where they're going to get the house that they like. They're going to get the house that they're comfortable in. When they make that mortgage payment, they're actually going to feel good about that mortgage payment. It's their own house. They don't feel like they do when they're renting and they're just paying a landlord for a house that's falling apart, and I don't want to fix it because it's not even my house. And this time, you're paying something that actually belongs to you. You take pride in paying for something that's yours. But we need that home buying class so somebody can open our eyes and say, hey, the budget is just not there because you're spending in the wrong places.
And then we would create that action plan for them to guide them through the home buying process and get them to that point to actually have the American dream, which is buying a house. So that's really, really good. Thank you, Leslie.
Thank you, Leslie.
I know that sending them over.
I know that right now, you mentioned something about the payment that comes out through there. It's a homeowner's insurance, but they also, a lot of clients come in with me and they tell me they confuse it a lot with mortgage insurance. Is it the same? What is mortgage insurance?
Okay, so I mentioned actually that mortgage insurance is the insurance that covers the lender, the bank. So just like any other insurance, life insurance, something happens to that, mortgage insurance, something happens to that mortgage, the house that's taken away, the bank is going to get paid a portion of what you owe because you were paying that mortgage insurance. But mortgage insurance is only required on an FHA loan and a conventional loan for a certain limit of time. So after a while, you may not have mortgage insurance coverage. And so to a homeowner, yeah, we don't want to keep paying on something that we really, there's no protection for us, but the homeowner's insurance is the one that protects the home from any damage. So homeowner's insurance is the common one that people know. You can go to, whatever insurance company you have your cars with and ask for a bundle of home insurance in it as well, or life insurance with homeowner's insurance. And so that's where if hail damage happens, the roof needs repairs, you can file a claim with your homeowner's insurance and that will cover the repairs. So homeowner's insurance is required on every house that you have a mortgage on. Just like car insurance, full coverage, the bank is going to require you to have full coverage. If something happens to the car, it's going to get fixed because you've got insurance on it. It works the same way. So you have to have homeowner's insurance on the home as well.
Oh, perfect. I know, not trying to rush anybody, but I know we have a little bit of time. So can you just make it something small about the down payment assistance? Because I know everybody wants to know about down payment assistance.
Yes. So a lot of people come to see me for down payment assistance. And I love it because to me, it's money that's out there for us to use. First-time home buyers or no first-time home buyers, down payment assistance is out there for people that reside in the state of Texas, for people that are buying in the state of Texas. There are programs out there that are there to help us have the down payment. Sometimes you might have the money every month to make a monthly house payment, but you didn't have a savings account to make a down payment. As a lender, we can't give you 100% financing. There's very, very few programs now that offer 100% financing. So down payment is key. On an FHA loan, you're going to need 3.5%. On a conventional loan, if you're a first-time home buyer, 3%. If you're not a first-time home buyer, 5%. But that's going to depend again on each individual, has their own different case. Well, for that down payment, there are programs. City of Laredo has a awesome down payment assistance program that for those that are now finding out, it's a limit of $30,000. That's a lot of money.
Wow.
That's a big down payment, but it has a lot of requirements like every other program does. So not everybody qualifies, and there is a lot of criteria. So we as a lender need to make sure that we take into consideration the customer situation to see if they meet that criteria. But if you don't meet the criteria for that program, we've got other programs. There's TSHAC, there's TDHCA, there's SETH. There's so many things out there that people might not know about. And then I have those customers that are readers, and they tell me, well, I looked in and I saw that there's this program and I think I qualify, and great. However, there's sometimes that fine print that they might not understand and not know. So, we have to take everything into consideration. There's debt to income ratio limits. There's income limit guidelines. There's programs that are only specific for certain job occupations. So again, as a lender, there's so many programs we always have to be on top of knowing about so that we offer the best possible program out there. Sometimes having the down payment assistance isn't the best for the customer because the interest rate is higher. The customer has excellent credit score. They have the income. They have money saved. They have a 401k that they can withdraw from for their down payment. And that is a better option than taking a down payment assistance that's going to tie them into a high interest rate loan because of the assistance they got. And again, that's in a case by case, depending on the program. Every program is different. Not every program specifies the interest rate you have to take.
But that's why you're there to explain that to them, right? To see what, all the different scenarios, what's best option for them, which is perfect. And thank you so much, Leslie, for all the information you've given the community to be better informed concerning the mortgage and what they need to know. And don't be afraid. Come to us. We'll give you the action plan. We'll get you to that point so you can buy a house. Now, I do have a couple of questions before we do leave. Leslie, let me go to them.
Let's try to answer them as
quick as we can.
In case your question is not answered at the moment, we will contact you. Please do give us your information so we can give you a call back. It is best to let you know by voice instead of sometimes typing it. Sometimes it's a longer question. So please, if your question is not answered, please send us your information so we can give you a call back.
Oh, of course. And one of the question is, what is your opinion on refinancing?
Refinancing is very good as long as there's a benefit. Not for us, the lender, to do a loan, but benefit for the borrower to refinance. There's not always a benefit. We recently turned some people down because they wanted to refinance, but it wasn't in their best interest. I'm going to add closing costs to the amount that you have to refinance, and you might have a higher payment depending on the term that you're going to refinance for, and you may not come out even at some point, So we have to take a look at that to see if it is in your best interest. They used to say if you were going to reduce your interest rate by at least a point and a half, it was good. That's very true in some cases. Maybe you only owe 10 years on your loan. Maybe you only owe 15 years on your loan, and refinancing is going to put you exactly in the same place where you're at. Well, then it might not be a good thing to refinance. We have to look at everything. How much is my new payment going to be? How much am I adding to my principal balance in order to refinance? And maybe that amount that you would be adding, you just need to send it in as additional principal, and you might be able to get out of that loan a lot quicker than the 10 years you have left or the 15 years you have left without the need to actually refinance and pay additional closing costs. So refinancing is good. It depends on the interest rate of your current mortgage, the term of your current mortgage, and what you're actually going to get on your new mortgage. Now, there are some cases that are absolutely necessary. I have to remove a co-borrower. No problem. We're going to do all we can to help you there. But there are specific cases, and we need to take a look at them.
Awesome. Another quick question, really quick, because I know we're running out of time.
Yeah.
What do you consider the FICO 8 score?
No.
Okay. I'm not sure. They're just asking me the questions. So I'm just wondering.
I believe that is another credit scoring. Yes, it's another scoring model, but it is not FICO 8, the one that we use. No.
Oh, okay. And not the Vantage, right? Tampoco.
And not the Vantage, correct.
Okay. Thank you, Leslie. The giveaway winner will be announced tomorrow through live. Stay tuned for that. Remember, tomorrow we're going to look at all the requirements that we had to look into. So don't forget about that. And also register. Give us a call for the Friday BBVA class about credit. Remember the do's and don'ts, the tips, how to manage your credit, how to improve your credit. Please give us a call at 712-9100 so we can register you for the class of credit for the BBVA. Thanks, Lindsay, once again for being our speaker for live. Always a pleasure. Remember, we are here to help you in all your housing needs. Okay.
So remember also, thank you, Leslie, for being here with us. I just want to add, if you don't feel ready to purchase a home, just remember that us, NeighborWorks Laredo, we will get you home ready. So give us a call again, 956-712-9100.
And thank you, Leslie. And if you have any questions, Leslie is there to help you as well. You know, the lenders are there to help you just as the counselors.
Yes. Thank you all. You all have a good day.
Bye.
Bye.